Welcome to session 3. We're going to talk about the financial reporting basics. In other words, why accountants think the way they do and what are the key words or concepts that they use in their thinking. So today we're going to talk about professional judgment, the framework in which accountants view the world, and give you an example of one. We're going to cover the basics of financial reporting concepts and principles and what those definitions are. And then we're going to look at the balance sheet and talk about how we value each of the accounts. Here's an example of professional judgment by one of the major accounting firms, EY, and it shows how they document their thinking when confronted with a question or a problem, and how they document their facts. So they define what the issue is, they gather the facts, they perform the analysis, and they make a judgment. But these are some of the things they think about, and what we're going to talk about today all informs their professional judgment. So this is just one example of many. The first thing you have to know is not everyone in the world thinks like the U.S. So there's something called IFRS, which stands for International Financial Reporting Standards. Think EU, think most of the rest of the world, versus U.S. GAAP. U.S. Generally Accepted Accounting Principles, GAAP. And you'll hear accountants say that's GAAP or that's not GAAP. The thing to know, or the fundamental basics, are that the IFRS or IFRS is principles based. There's not a lot of rules and regulations. They have broad concepts that accountants apply to different situations to inform their judgments. So we always say they're principles based. Whereas in the United States, where we're a little bit more about suing people, we're rules-based. In other words, we have a lot of specific rules that cover specific situations so you know what to do. So it's not so much broad revenue recognition, but it is specific rules that you can implement or that you can follow when recognizing revenue. So that's the difference. IFRS, US GAAP. US GAAP and IFRS were trying to harmonize, and they have harmonized somewhat, but there's a further way to go. So sometimes there will be differences of approach when you're talking about how we prepare financial statements for the U.S. stock markets versus how the rest of the world prepares financial reporting. And I should say the U.S. stock market will take either IFRS or U.S. GAAP prepared financials. All right. When you read your chapter, they do a really good job about explaining the difference between input market and output market concepts. When we do financials, you're always trying to come up with the number, and the number usually comes back to how much does it cost. So what should the value or the number be on the financial statements? And that many times is dependent upon your perspective. So if your perspective is an input market perspective, meaning you are the purchaser, you're more likely to put on your financial statements, what did it cost you? What's the original cost? Sometimes also known as the historic cost. Or if you're thinking about you were in a fire and your building burned down, you might want to take the insurance approach. And the insurance approach is, what is the replacement cost of that building? What will it cost you to replace it? So both of these are based upon how much does it cost, but notice it matters about when you incurred the cost or either in the past when you bought it or now when you have to replace it. So that's input market. Purchaser perspective, how much does it cost? And we will use both of these in your financial statements. Output market says that we take more of a seller perspective. How much can I sell it for? So when we talk about revenue, we're always talking about what can I sell it for at present, whether that's the full selling price or a discounted selling price. It's what can you sell it for right now. Other times we'll look at what's the fair market value. And the fair market value says, if I was to sell it today, what would I sell it for? What is its fair market value? Where we get into this is with marketable securities. Marketable securities are where we buy stocks in other companies because we have some extra cash and we just want that cash to make a little money and not just be sitting around. So we buy marketable securities and we record them at their cost, but then periodically we go in and we mark them up or mark them down to their fair market value. And that's called marking them to market. So this is an example of where it may be originally recorded at its input market, but over time, as we look at those securities value to us is really what their fair market value is at the time I prepare the financial statements. So that's just an example. All right, here is Alphabet, and it's the balance sheet, and you can see it's quite the balance sheet because it has lots of different categories of assets. And I thought it would be good to take this to kind of talk through that this is all not recorded at its cost, whatever it was. So for example, we have cash and cash equivalents. That means cash and near cash, which would be money market funds, those other things that are very, very liquid, meaning I can convert them to cash quickly. And cash is kept at its face value. The problem usually with cash is, did you include all of your cash? So if you think about you and I, and you ask me, how much cash do you have? You would go and say, well, I have so much cash in the bank. But you also have cash in your pockets, in the washing machine, the dryer. You have cash scattered throughout your drawers. You have cash in the sofa. So how much cash do you have? Again, it's the best estimate you have at a moment in time. All right, lower of cost or market. Lower of cost or market is what we keep inventory at. So inventory may have cost you so much, and inventory will stay on the books at its cost unless the market value of your inventory declines. So for example, if I'm Apple and I have an iPhone, once a new version of the iPhone comes out, the cost of the old iPhone may go down because it's not worth as much as it was in the past. So how much does it cost varies tremendously with the moment in time. I should have given you a better example. A better example is right now. Think of all the retailers whose stores are closed. What they paid for that inventory is no longer relevant. They've got to sell that inventory from closed stores with no customers, so they're turning to online. And notice the deep, deep discounts they're willing to sell their merchandise for. And that's the lower of cost for the new market because they've got to get rid of that inventory and they're not considering its cost anymore. Other things, the original cost is used for land and long-term investments. What did it cost you to buy that land? What did it cost you to buy that building? And that is its historic or original cost, and that's what we depreciate from, is the original cost. Not what it's worth today, not what you could sell it for today, but what did it cost you? Another term is net realizable value. And net realizable value says that things like accounts receivable, yes, I sell to customers on account, but I realize that I'm not going to realize all that cash from those accounts receivable because some customers are not creditworthy, deadbeats, or life happened to them and they don't pay their bill. So we show accounts receivable at their net realizable value, meaning the amount of the account receivable less an allowance or an estimate of what we think people, customers, are not going to pay. So notice for Alphabet, they may have sizable accounts receivable, but they also try to be realistic in how much cash those receivables are going to realize them. That's the net realizable value. When we talk about property, plant, and equipment, we said we record it at its cost. Minus accumulated depreciation means that's its book value. So when somebody talks about the book value of your car, that doesn't mean the value is found in a book. What it means is it's the cost of your car minus the accumulated depreciation. And that is also true for intangibles. Intangible assets, notice, are net, and that's net of the impairment that may be on those intangible assets. Impairment is very important nowadays because of the huge falling, failure, disaster of the pandemic, that things are not going to be as much of value as they used to be in the past, and it's because they've been permanently impaired by the facts and the circumstances of today. Current liabilities are kept at their face amount, and the reason they are is because those are the things that you've got to pay within the next year. So the face is very relevant to that. Fair market value, remember those marketable securities? We mark them to market, and so they are shown not at their cost, but at the market value of them, their fair market value, at the date of the financial statements. And finally, long-term notes receivable and long-term liabilities, many times those are kept at their present value. In other words, in today's purchasing power, what it would cost for those responsibilities, for that debt, or for those long-term notes. So that's in today's dollars, not I took out a loan for $10 million that is due 10 years from now, because the purchasing power of a dollar 10 years from now will be a lot less than the purchasing power today. So that $10 million loan that I borrowed may show up on the balance sheet at its present value, which may only be, say, $300,000, because of today's dollars, today's purchasing power versus the purchasing power of the future. So those are some examples of how much does it cost on a balance sheet. When we look at the overall structure of the concepts that support accounting, the first thing you want to know is, why are we doing this? Why are you in this class? And the reason is, it's all about useful information. So we want useful information for our users. And those users can be investors, can be creditors, can be capital markets, it can be a lot of different things. But we want to provide useful information. How we do that are based on some assumptions that have developed over time. Remember when we started the class and we talked about, we had the day of reckoning where we did accounting by the deal, and then all of a sudden we had the income statement, and the income statement assumed a going concern, that we were looking at an economic entity, that we had agreed upon a money unit, and that periodically we wanted to figure out how things were going. So that's the how. The in-between, the qualitative characteristics, inform our framework of decision making as to what we're thinking about when we reason through an issue. And the elements are things you already know about, the ones that have to do with the balance sheet, which is at a moment in time, what is an asset, liability, and equity account, and those that have to do with the income statement, which have to, and the income statement goes through here, which has to do with the passage of time. And then we haven't talked about this too much, but this is that statement of shareholders' equity and other comprehensive income. So more on that later. So assumptions. Well, economic entity. That is different from the legal entity. A legal entity may mean that I am, as a person, a legal entity, but I can have an economic entity known as a sole proprietorship or an economic entity known as a partnership that are separate from the legal entity of me. I can also have a corporation, which is both an economic entity and a legal entity, because they're identified and the rights and responsibilities legally and economically are the same. So the important thing about an economic entity like a sole proprietorship, a partnership, or a corporation is I'm able to identify what assets they have and how to measure them, and that I want to know how are you and how's it going for that economic entity, which means periodically I'm going to say time out. I want to do beautiful financial statements to find out how I'm doing. But the underlying assumption is that that entity will keep going. It doesn't close out and have a day of reckoning every single year or every single deal. We assume that that sole proprietorship, partnership, or corporation is going to continue its life. And as we said at the very beginning of the course, you need to have agreed upon measurements. And those measurements need to be pretty stable over time, otherwise we have to do things for inflation accounting. The principles that we look at as far as measurement is concerned is that measurement needs to be objective, meaning it can be verified and documented. That's why we're always looking for what's the invoice, what's the piece of documentation that provides the evidence to why I assigned that dollar value. I need to assign it or apply it consistently. If I use one method in one period, I need to use the same method in the succeeding period or preceding period. So there's consistency of approach when I'm doing my measurement. Now there's two exceptions to this, and we'll talk about those a little bit later. But materiality, meaning if it's so little it doesn't make a difference to the users, whether you use this or that, then it's not material, immaterial, not worth thinking about, too little. Conservatism says, if in doubt, understate your assets, make them too little, overstate your liabilities, make them big, accelerate your losses, assume that the worst is going to happen, and delay your gains. Good news, you can wait for it to actually happen. So conservatism is also things that shade our perspective. Revenue and expense recognition we'll talk about, and we'll also talk about matching and full disclosure. But know that whenever we do any of this stuff, that the constraint is cost. In other words, the cost of doing the accounting must be less than the benefits derived. Okay. So the cost of doing the accounting must be less than the benefits derived. So when you change a way of doing accounting, for example, leases, and that's one that's been changed lately, the big deal was that it was going to cost too much to change all the accounting records on how companies handle their leases. But you're going to change how you're going to do lease accounting. So, revenue recognition. We know under accrual accounting that you recognize revenue when it's earned. And when it's earned, it means that the performance is satisfied. That used to be pretty simple, that when the title to the goods passed, you recognize the revenue. But revenue has gotten a lot more complicated lately, because what we're going to do is we're going to look at revenue as a bundle of services, or a bundle of things of promises that we say we're going to perform. And we will recognize the revenue as we perform each one of those tasks in that bundle. So more on that in a second. Expense recognition, let the expense follow the revenues. And that's pretty easy to do if we're doing product costs, because we know how much it costs to produce something we're selling. So if I'm selling shoe boxes, I know the materials, the labor, and the overhead that went into making that shoe box, and I recognize the cost in cost of goods sold, and because it's traceable to the revenue. But there's also expenses that are period costs, and those are not traceable to a particular dollar of revenue, but more relate to the passage of time. And those include selling, administrative, and general. And so you have to come up with some basic frameworks of when do you recognize selling expenses? Well, when I make the sale. When do I recognize administrative and general? Well, if my employees work this period, then maybe I'm going to include their salaries and wages this period. So we try to think about practical, not onerous ways of matching the expense recognition with the revenue recognition. All right, more about revenue. What you find in your book is wrong. So notice I have text 4 steps. That no longer pertains, no longer is relevant. What is true now is you come up with that bundle of tasks or duties that you are going to do. So in this example, we are signing a contract to deliver airplanes to Delta. Now, if all we're doing is delivering airplanes to Delta, then the revenue will be recognized when the airplanes are delivered and the title to the goods passes from Boeing to Delta. But usually when you sell an airplane, you're also selling some service contracts, some maintenance contracts, some training contracts, other things that also go into that selling price. So there you have to allocate the selling price among the various tasks, and you recognize the revenue as you perform each and every one of those tasks. One of those tasks may be that you offer a warranty. Well, if you offer a warranty, you can't recognize that revenue really until after the warranty has expired, because you have promises or obligations during that warranty period. So as you can see, revenue recognition has gotten a lot more complicated, but it's made easier through the idea of smart contracts, or the automation of legal contracts into its various parts, that the computer can keep track and recognize revenue as it is earned. Full disclosure means that you need to give sufficient information to the user that they can make informed decisions. You're not supposed to window dress. You're not supposed to mislead. You're not supposed to be too effusive in your comments. You need to give them the facts and other information that would be useful in their decisions. And that's usually done through your annual reports. And your annual reports, which are produced 3.5 months after year end, include the financial statement issue BS cash flow, the notes to the financial statements, which we'll start digging into after the midterm, and additional supplementary information that helps bring the full picture into perspective for those users. So today we've looked a little bit at the conceptual framework, and we will spend more time on it in the next few videos. Thank you.